Okay. What I would like to do first off, before we actually officially start, if one of you, each of you one at a time would like to unmute yourself and tell me kind of, and all of us actually, where you are in trading, what your experience has been, what you're trying to accomplish. So maybe we can be more specific for your needs. So how about Robert, you want to go first?
Sure. Where I'm at in trading is I currently trade covered calls and cash secured puts, and I just do those kind of on a weekly basis. And that's been very successful, but I can't attribute that just to myself. I think it's because we've been in the up market for so long. And I guess my biggest problem is just getting taking action. You know, there's other trades I'd like to take, but I just haven't pushed myself to do that yet.
Okay. I want to commend you on selling the calls and the puts. That's an excellent strategy.
Oh, thank you.
Okay. Divine Values School, can you unmute yourself and let me know where you are in your trading world?
Yeah. Hey, Ron. This is Nick. Can you hear me okay?
Yes. Yes. And you say your name is
Okay,
Nick?
cool. Yeah, Nick. Yeah, Nick Rigney.
Oh, okay. Oh, hi there.
Yeah, that's my wife's. She uses my computer for her work, so that's why I got that call sign. Yeah, mostly just doing some long trades with the market, and then been doing some covered calls, some straight call options, but not too much. Been busy with the day job, but that's on a minimum basis. But that's where I'm at.
Okay. All right, cool. And then if you mic yourself again, and we'll go on to Han, if you'd like to unmute yourself.
Hi, everyone.
Hi there.
Can you hear me? Yeah. So regarding trading, so I have a very minimum experience in trading. I just invest in stock a little bit. So I want to explore more. I know the concept. I have my background in finance. So and I used to work in that. But I'm not like a direct trader. So I want to learn more about it and to see that it's like because I want to have the other option beside real estate. So very much is for learning purpose.
Okay.
At this stage,
okay.
Yeah.
Okay, great. Thank you. Okay, PK can hear me. No mic. Okay. Can you type in a little bit about your trading history, PK, and what you're looking to get out of this class so that I can tailor it maybe a little more specifically? Okay, while we're waiting for PK and Casey to respond, let's get started. So welcome everybody to our webinar. My name, of course, as you know, is Ron Harrison. And today I'm going to teach you how to trade without fear. And the reason that I called it that is because I found that with a lot of my students and even people that aren't students, that a lot of times with lack of proper knowledge, or if there's things that that the trader is unsure of, in many cases, fear creeps in. And we're going to talk a lot today about emotions, fear, greed, and ego. But a lot of times, lack of proper knowledge or proper skill, or even experience, you may have the knowledge but not the experience, ends up allowing fear to creep in. So you start to being hesitant about trades you're going to make, afraid of what the market might do to you, just different ways that fear creeps in. So hopefully today, once we go through what we're going to cover. Okay, now I'm guessing for a lot of you, this is probably not your first webinar on trading. And the first thing I don't want to mention is that if you failed at trading in the past, believe me, it's not your fault. There's a lot of information out there and it can be confusing. A lot of the times, really confusing. So many times that information overload keeps you from success, but that's okay. And if you've been concerned in the past that you just can't succeed at trading, I want to put those fears to rest. You can do this. You just need the right person to teach you. And the big brokerage firms want you to think that you need a lot of venture capital or some fancy college degree to be successful. And I'm here to tell you that they're wrong. They have their own reasons for wanting you to think that, but it's not true. And if you ever thought that the government or the big banks or the brokerage firms actually want you to fail, you're probably right, because they don't benefit from you succeeding. They want to keep you in debt, which means you end up needing them, and that's how they succeed. The more you need, the better they do, because that's the business they're in. And the difference with us is that we actually care about your success and truly want to see you make a living and change your life and live your dreams. And like the government, the banks, and the brokers, we need you too, but what we need you to do is spread the word about us. It's our philosophy that if you succeed, then you will spread the word about us, and then we'll succeed. So we think that's a much better business plan. So that's what we're here for. I know you have a dream to change the world, make an impact, and I want to show you how you can make that happen during this webinar. And my goal for this presentation is to help two types of people. For those that are beginning traders, you'll get the necessary basics to build a solid foundation for your trading business, and I will show you the strategies that you need and what you really don't need or what you want to ignore. And I will get you started on the right path to allow you to grow and succeed. And for the more experienced traders, you'll get some valuable and powerful new trading strategies that will enable you to generate a consistent weekly income. And I'll also show you how to diversify into all three major markets without requiring a massive trading account. So again, my goal for this masterclass is the best way for you to exponentially grow your trading is through the proper knowledge and skill set. In other words, a proven, workable trading plan. And the best way to acquire that knowledge and skill set is through Traders Academy. So here's the topics that we're going to cover today. First off, how to begin learning trading when you're just starting out, for those of you that are in the earlier stages. How to decide which markets to trade. I want to give you 10 reasons to sell options. How to filter through the media noise, which is always a problem. How to set up your charts to determine where to enter and exit a trade. Then how to construct a synthetic covered call trade, or better known as a poor man's covered call. Then how to construct a synthetic covered put trade. Then how to trade futures in a small account. Number 9, how to trade Forex without having a Forex account. Then how to trade a market that appears to be overbought, which is what we are living in right now. How to recover and deal with a recent loss. And how to understand and use the power of compounding to build or even rebuild your account. And plus at the end, we're going to have unlimited Q&A, so all the questions you want for as long as you want. So my story as a trader, I started many years ago, probably 1989-ish, right there. Made my way to Manhattan, got a job as a broker, started working at several firms as a broker, which is, believe me, the worst job in the world. But what I gathered, what I gleaned from all of that experience is, first off, during my tenure as a broker, you have no idea how unknowledgeable brokers are. As I tell my story other times, in order to become a broker, you have to pass a Series 7 test, get licensed, then you're allowed to work at a firm and start selling whatever it is they're selling. And in that class that you take, in that course you take to pass that test, there is not a single thing in that entire course that teaches you how to look at charts, how to analyze charts, how to analyze stocks. Nothing. It's all about what to say and what not to say, and when legally you can say this and legally you can't say that. So then you go into the firm, you start your job, your career, your new career as a broker. You know nothing about what you're talking about. You are given the call sheets, once a day, once a week, however often they do it. You're given a call sheet which lists all the particulars about what you're going to say on the phone. And then you sit down and you start dialing for dollars, is what we used to call it. So you get someone on the phone, you go, Mr. or Mrs. So-and-so, I have this great stock I think you should look at. I've done all the research. This is blah, blah, blah. You start reading off what it says on the sheet, and you have no idea what you're saying, no idea whatsoever. So anytime some broker calls you up, usually in the evenings when they do it. Believe me, they have no idea what they're talking about, and even though they may sound like they've done all that work, they're reading it off a sheet of paper because that's all they know. So avoid that if you can. So anyway, I did that job for, I don't know, 2-3 years, bounced around from several brokerage firms, keeping thinking that each one I went to was actually going to be something better than where I was. The final firm that I worked at as a broker, it was a firm that issued IPOs, companies that are going public. So that was their primary function, was to take companies public. And the way they did that was basically the company would come in, they would get the whole thing put together, and then they would give those shares to their brokers. And I think that firm had, I don't know, not quite 1,000 brokers, but up in the high hundreds of brokers. So it was a pretty easy task to take a company, assign all your brokers to start pushing that company's stock, and you could move a lot of stock in a couple days. Everyone would call their clients, and each client would take some. So of course, since it was all buying at that point, price went up, and everybody looked good, and the company looked good, and the firm looked good, and the stock looked good. And again, that's because there was only buy orders, no sell orders. So after one of the companies that we took public, and actually it was a company called Pure Water, I think they're still around, the water purification things you attach to your faucets and stuff. One of my clients called up and said, I'm buying a house. I need some extra cash. I'd like to take some cash out of the account, sell some stock for me. So I said, okay. And keep in mind, I was still new at this firm. I said, okay. So I went and wrote up the order, went up to the order window. At that time, back then, you had to do it by hand through order windows. It wasn't computerized like we are now. So anyway, so I turned the sell ticket in, and I'm told, nope, can't do it. We're not taking sell orders at this time. We'll let you know when you can do that. And I said, what do you mean? My client wants out of this thing. Can't do it. So I said, so what am I supposed to tell her? I said, they said, go back to whatever you got to tell her, it doesn't matter. But right now we're not taking sell orders. So to make a long story short, as it turned out, what was happening with that firm and other IPO firms as well is that when the company I worked for, when that brokerage firm would take a company public, they would, in the beginning, end up buying up a lot of shares of the stock. And you're not supposed to do that, but they would have it set up so that they would buy that stock through a friend or friends. And those friends would hold that stock. Well, as it turns out, when a company goes public, there's a quiet period to where insiders can't sell stock. And that's in order to protect the public who's buying the stock at that point. So what this company was trying to do is they were not going to take a sell order until their people could get out at a profit. And they wanted that to happen at the high of the price of the stock. So they knew that as soon as the quiet period was up, then there would be selling, and they wanted to be sure that their people got out first and got top dollar, which actually was their own stock and their own money. So no sell orders until they said so. So that was really the last straw. I went back to my client. I said, look, they won't take sell orders. I don't know what to tell you. I tried. And I told her that was going to be my last day there. I quit at that point. I quit that day. I had had enough of being a broker. And I don't know what happened with them after that. But one thing that's I always think about is that they might have picked the wrong person, because this particular lady was an assistant producer for 60 Minutes. So who knows where that went from there. But there was a lot of that going around in other firms during that period of time, like the early 90s. So the next step in my career was each firm that I was at, I always noticed that there was like a back room where they had a bank of traders, and those people were trading the firm's money. They weren't on the phone trying to push stuff to people. I used to call people I don't know and try to sell them things they don't want. These people were actually trading. They were actually doing what I thought I was going to be doing back in my naive days. And so as it turns out, I had befriended one of the traders at the very first firm that I was at, and I had kept track of him over the years. So I called him up and asked him if any chance I'd get a job working where he was, which was purely a trading firm. It wasn't a brokerage firm. And he got me an interview. I got hired. So there I was. Now I was finally sitting behind the computer actually trading stocks, which is what I wanted to do. So at that first firm, that was really day trading is all they were doing. We were just buying, and I didn't know any better then either. We were just buying large chunks of stock, hoping it to move a few pennies and make a little profit and then get right back out of it. So quick ins and outs. And then from there, I left. I went to a couple other firms as a trader. Again, a lot of times when you move around, you kind of improve your position just by moving, the same as it happens with any other company, any other industry you're in. You can probably do better by jumping ship and moving to different places than you can by staying in one company and working your way up. So anyway, so I kept doing that until I ended up at one of the real firms, which actually was Bear Stearns at the time. And when you go to work for a bigger firm, you have to go through a course, because if they hire you, they want to make sure that you trade their money their way. No variations on that. So the course, I went through the course, was assigned to the options department of Bear Stearns. And where I'm going with all this is that at that point, during the course of taking that course, a light bulb went off in my head. It was like an epiphany. And what I discovered and learned is that there are two very different sides of Wall Street. One being the brokerage portion of it, to where they're calling you up, dealing on the retail side, pushing their stocks. Basically, it's a retail business, just like Walmart or any other business. You have product, you have to move the product, and the method is through the brokers to the retail people. They're moving their stock. And that was one side. And of course, the other side was the side that I was just being initiated into, which was the institutional side, to where the firms trade their own money for their own purpose. And what they do there, I found out, is basically 180 degrees different than what the broker side does with the retail money. So the perspective that I got from working inside the firm to see the difference between what the retail side does and what the back office side does was unbelievable. And that changed my outlook on Wall Street and trading forever. And that is how I've traded ever since then. That is the same methods that I teach in my classes. And that's a lot of what we're going to talk about today. So I just want you to know, as far as I do a weekly radio show, I do blogs, I do a lot of training videos, but my radio show is called The Other Side of Wall Street, and that's really where that came from, because while I was there, I realized that there is a very different side to Wall Street than what the general public and the retail people see. So now what I want to do first is I want to show you a couple actual accounts and the results that they are getting. Okay, this is Thinkorswim platform. This is one of my clients' accounts. There's two accounts in here. He has his regular account and an IRA. So what I would like to do is just show you actually in his live account. We can go up here to account statement, and we can go back for as long as we want. What we're going to do is go back, I think 270 days, I think is as far as we can go back. No, 370. Let's go back 370. So a little over a year. Okay, so as you can see here, we have gone back to January 6, 2019. And you can see that his balance at that point was $525,078, $525,078.91. And to jump ahead to January 10th of 2020, you'll see his balance now is $758,363.68. And just to look at that in a different way, let's go back 90 days. Okay, so here on 10/1, you'll see his balance is $693,201. So let's go down to 11/1, from $693 to $713. So you can do the math on that. Again, 693 to 713. That's hundreds of thousands. So 693,000, 713,000. Then if we go to 12/1, so again we're starting at 713,000. 12/1. Now we're from 713 to 733, so about 20,000 for that month. And then from 733 to January 1, 756. Good month. That was a good month for everybody. That's in that account. If we look at the other account, again, we can go back 370 days. And at that point, for January 6, 2019, 678,494, from 678 to 768. And same deal if we go back to 11/1. 11/1, we're at 727, 756, so 727. 12/1, 795, $100,000, $795,000. And January 1 is 766. So that just gives you an idea of what is possible. And of course, this is a big dollar amount accounts, but the percentages would be the same. So let me stop sharing right now, and I'll go back to the slide presentation. That gives you an idea of what is possible with the kind of strategies that we use. Of course, the numbers would not be as big if the account was smaller, but what I can promise you is the percentages would be about the same. So now that you've seen what's actually possible, we still have a lot to cover, so let's get started. So first I want to start off by combining items 1 and 2 since they are so closely connected. So how to begin to learn trading when you're just starting out, and also how to decide which markets to trade. So first, I want to commend all of you for being here today and having a desire to learn, and so many traders that I've seen do exactly the opposite. They don't take the time to learn, they just fund their accounts, start trading, and the results are more times than not bad. And also, most books are lacking in necessary amount of information needed to prepare you for the actual process of trading. But what you need to realize is that learning to trade is a process. And like with any process, you need to follow a specific order to accomplish that goal. And also, it's a fact that most classes seem to talk way above the attendee's head. And this is by design. It's not their goal to give you proper amount of knowledge to enable you to actually trade with any success. Instead, it's their goal to give you just enough information for you to become interested enough to continue with them and take more classes. And it's called the upsell. And this process goes on until they've managed to extract as much money from you as they can. And in most cases, even then, you're still not ready to trade. So as I've stated, learning the amount of information needed to safely begin trading will be a process. But the good news is that by breaking it down into separate pieces of the larger puzzle, it will make the process much easier to complete. And that's what I want to do here today. So because what you don't want to do is try and learn it all at once. In that scenario, you might just end up trying to juggle too many pieces all at one time, and it generally affects your learning ability, and you just end up being confused, let's say. So now let's identify the separate pieces so that you can get started. And before we identify the individual pieces, I want to first say that I feel it's important to try and attack these pieces in a specific order. What you want to happen is, as you progress through each piece, that they build on each other. In other words, you want the first part to be a foundation for the second part, and those two parts to be a foundation for the third part, and so on and so on. So if you start jumping around, you will lose continuity, and it will just make the whole process far more difficult. So let's identify your steps. First off, and if you're, again, beginning, just getting into the markets, you're going to need to decide which market you will trade. You can later trade multiple markets, but first you need to master one. And your choices are going to be, you can trade equities or options on equities. You can trade futures or options on futures, and you can trade currency or Forex. And of course, you can do options on those also. Keep in mind that the choices on the last slide are also a little misleading because you will first need to decide between equities, futures, or currency. Then once you pick one of those three, you can then either trade them directly, in other words, buying or selling the underlying directly, or if you decide you want to trade via options, then you would also have to study option trading in addition. But the good news is that once you understand how options work, you can apply that to any of the three. It's going to work the same way. So once you make your selection, and in the event you want to go with options, then the next piece of the puzzle would be technical analysis. And this will be the basis for all your decisions on picking the trade, when and where to open the trade, and when and where to close the trade. And almost all of your decisions will be made using technical analysis. The theory behind that is that all known information is already priced into the stock or whatever instrument you've chosen to trade. So all of this information is reflected in the charts. So hence, all of your decisions should be based on charts. Now, this may seem like the most complicated piece to master, but if you look at it just like we're looking at the overall process and break it down, this piece is not going to be that hard. And next we'll move on to fundamental analysis. This section will be the easiest because we only need to understand what events or announcements will be made that could affect the price movement of whatever you're trading. In essence, it's just being aware of news events, what and when they'll be released, and just generally being aware of those things. And the last major puzzle piece is what I believe to be the most important by far, and that is also what is most overlooked, and that is your trading psychology. So few people even teach this because few people even understand how much damage it can be caused. And as a trader, you can study all you want, prepare yourself with as much market knowledge as possible, create a perfect trading plan, and we're going to talk more about that. But I can promise you that no matter how prepared you are to trade whatever market you picked, there are three things that will cause almost any trader to fail, and that is your fear, your greed, and your ego. And if left unchecked, these three emotions will cause you to make decisions that are damaging to the extent that, you can look this up, 90+% of most beginning traders fail and totally give up. I don't want to scare you away, but instead just make you aware of exactly how important it will be to spend extra time on this section. It's a 100% sure thing that you will need to understand how your emotions are going to react during your decision-making process and have the proper measures and safeguards in place to keep you out of trouble. And I know, and I also preach this too, that in the beginning, many times it's better off for beginning traders to paper trade. I think Thinkorswim has a wonderful paper trade and option, and other brokerage firms have it too. But I always tell my students that, if you could paper trade for 6 months to a year, learn how the strategies work, learn how the platform works, learn all the mechanics, and keep doing it until those things become second nature, and then switch over to live trading. But what happens is when you go from paper trading to live trading, all of a sudden you're trading real money. And your emotions, your fear, greed, and your ego have not kicked in at that point until you go to real money. And I can relate that to my own experience. After I had worked at Bear Stearns for a while trading their money, I thought to myself, well, and this is after about a year, I know what I'm doing. It's working fine. I'm making the firm money. Everything is just very methodical, mechanical, hardly requires any thinking anymore. Why am I doing it for them? Why don't I just go and do it with my own money? I couldn't trade my own money there because that wasn't how it worked, but why don't I just leave and go trade my own money? So you can guess I did just that. I quit. I went home, set up my little trading room in my house, started trading my own money, doing exactly what I was doing when I was at the firm. It worked good for, I don't know, maybe a week or two, not very long. And then I started bleeding money. Things started going bad, and then it kept getting worse and worse from there, to the point where I was almost totally out of money. And I had no idea why, because as far as I could tell, I was doing exactly the same thing I was doing there. I was doing it here with my own money. And in that sentence was the clue. What had happened was when I was trading their money, it was very mechanical. I did what I was supposed to do. I followed the rules. I traded. Things worked, but it wasn't my money. So that's why it was so easy. When I started trading my own money, all of a sudden fear and greed kicked in, and I didn't realize it because the third emotion of ego was covering it up. My ego was telling me that you know what you're doing, you have all the plan that you used at the firm, just do that. It's got to be something else. Maybe it's the market screwing it up, maybe whatever. It could be anything but me. And in reality, it was what was in my head that was screwing it up, because my fear and my greed was causing me to unconsciously adjust the trading to counteract what the fear and the greed was making me feel. So anyway, when I started trading my own money, things started going bad because emotions kicked in. So the point is that I think that no matter what system you trade, I mean, you can go out really and go to Barnes & Noble and buy any book you want or take any course you want, and the majority of them will probably work. But the reason when they don't work is because of what's inside our head is our emotional makeup, our trading psychology, our trading mindset, whatever you want to call it. That is what causes, and I'd almost guarantee you that out of that 90+% of beginning traders that fail, it's not because they're not smart enough to do it. It's not because the trading plan that they're using, and it could be, but most times it's not, that the trading plan that they're using is not working or is not done right. Most times, I'll bet you at least 9 times out of 10, they fail because of emotions, and their emotions lead them to totally take something that is workable and tradable as far as the plan goes and morph it into something that is a total disaster because of fear and greed. So I can't emphasize enough how important that is in your trading. If you can master those 3 elements there, I think you're going to be doing fine. And if you don't master those, you are going to be part of this 90% more than likely. Once you get past that, the last piece of the process for you to complete is actually the fun part, and that's your trading plan. Every new business should have a solid business plan before they ever open for business, and your trading has to be a business, and it too will need a trading plan. You will need to sit down and create and actually write out your trading plan. Don't borrow it from somebody else. Don't copy it from somebody else. Write out your own, because it has to be matched up to your personality, and we're all different. And this will be a set of rules that you will use to make all of your trading decisions based on the other pieces of information that you've already mastered. So the purpose of this is for you to have in place a solid set of rules to guide you through your everyday decision-making process while you're trading. And the reason for having this in place is because without it, you're going to be left to your emotions. And I can promise you that they will be right there beside you, more than happy to make your decisions for you. And I can also promise you, you will not like the outcome. Okay, so now that you've completed and assembled all the process pieces, you're ready to begin trading. Now you should have enough knowledge and skills in your toolbox that your fear of jumping into the trading arena should be gone. And if all of this that we've covered seems like a mountain of information to fully understand, I can promise you it's not. In fact, we're going to continue to break it down, this process, as we progress through this masterclass. So the first being, one of the things that I learned early on at Bear Stearns was that options are a very, very profitable way to trade. It's also a very disastrous way to trade. And what I mean by that is that the brokerage firms decided to come out with options a long time ago because they realized that there was another whole group of people out there. It wasn't just the buy and hold people that love to buy stocks and sit on them and feel like they were making an investment in the company. For all the, the early on people that really were the true Wall Street people, people that would research the companies and pick one they liked and buy stock and go along for the ride. There's also another group of people out there, and those are the gamblers. People that go to the horse races, people that gamble in casinos, people that like to bet on anything, the gamblers. And those people didn't take the brokerage firms too long to realize that there's a lot of money to be had there, So how can we entice those people into the stock market? Because those people are not going to put up large chunks of money to buy big sections of stock, because that's not how they operate. They want to put down a small amount of money, cross their fingers, and hope they win, like at a racetrack. So hence, options were incorporated into the stock market to where now the gambler can come in and bet a small amount of money and hope that stock moves and hope that they make some money at the end. Well, options have a time limit on them. They are going to expire. So that works against the option buyer. So they would end up putting down the money, buying the options, and more times than not, the option, it would come to expiration day, the stock has not moved, or it may have moved in the wrong direction, the option expires worthless, they lose all of their money. So if you look up any of the statistics on options, you'll find that the majority of options, the very high percentage number, expire worthless. So that means that that same high percentage of option buyers lose their money. And that's why options have such a bad reputation. I would venture to say that if you went to one of your friends that maybe knows something about the stock market and said that I took a course on options and I'm going to make a fortune, and they would probably tell you to run the other way, because most people, the concept of options is buying options. They don't know that you can sell options. So think of it this way. If the buyer's side has, let's just say, a 85% chance of losing whatever they spent. So if 85% of all options expire worthless, that means 85% of the people buying options lose money. Then the opposite side has to have the equal and opposite odds. So if the buying side has, and I'm just making this number up, 85% chance of losing, the selling side has to have an 85% chance of winning, because it's a zero-sum game. Money has to go somewhere. So that is a very eye-opening fact that I learned when I was working as a trader. So ever since then, I only sell options, and it's a very profitable way to trade. And I know one of our people here today, Robert, that's what he does. So let's go through 10 reasons that you want to sell options. Not buy, sell. First off, it generates a weekly or monthly income. So one of the greatest benefits of selling options in your trading account is that it provides a steady cash flow into your account. So I'm sure all you're familiar with buying options. Well, the money that you pay when you buy an option must go somewhere. And you guessed it, that money goes to the option seller. It's called the premium, and this premium can be collected by you on either a weekly basis or a monthly basis. Think about how nice it would be to have a steady stream of cash being deposited into your trading account on a steady, regular basis. It's like having your own cash-generating kiosk in a busy shopping mall, just generating cash every week. Number two, it puts the odds greatly in your favor. So if you know anything about options, then you know they have the worst reputation possible, like I just described. They are widely known for losing money. In fact, if you Google this, you'll find that a very high percentage of all options expire worthless. Therefore, buying options has such a bad reputation. If you are a buyer of options, which sadly to say most traders are, then you have the odds stacked largely against you right from the start. So therefore, if you place yourself on the opposite side, the side of the seller, then you have the exact opposite odds. The odds are now greatly in your favor for success and profit. And never forget that in trading, it's all about the odds, and the better you can put those odds in your favor, then the more success you're going to have. Number three, less capital outlay. When you sell options, as we've been already stated, you collect a premium. This premium is deposited into your account at the time the trade is filled, so you're taking in money into your account. You're not actually spending money. So initially, you will spend nothing, and if your trade goes perfectly and the option expires worthless, can't talk here, then you will not spend anything for the entire life of the trade. But in some cases, if the market moves too much in the direction of your option position, you may have to adjust your position. Now, in some instances, you will still not have to spend any additional funds, and you might even collect an additional premium. But there could be a situation where you will have to pay a small debit to do the adjustment. But these are rare. before your trades are non-directional, if you do it correctly. One of the biggest problems in playing the markets is that most people only think that you're supposed to buy something in order to play. And you buy shares of a company stock, you buy a futures contract, you buy some gold to hedge, etc. Whatever you're doing, you're buying. Well, the problem with this is anytime you buy one of these, then the product you buy has to move up in value in order for you to profit. So the problem with this is that all these products are, and in fact, all products that you can trade move in three directions. Of course, one of those is up, but we forget that they can also move sideways and, of course, down. As we've already stated, when playing in the markets, it's all about putting as many odds in your favor as possible. Well, for those of you that play the markets from the long side, which is buying, then in this case, every time you place your buy order, then you start your trade with an only 1 out of 3 chance of winning, which is not good. Or another way to look at it is a 2 out of 3 chance of losing. And this is not a good formula for long-term success. Now with options, and more specifically the way we teach how to trade options, you have the ability to construct trades that are non-directional. In other words, you'll be able to profit if the underlying moves up, trades flat, or trades down. So instead of having the 1 out of 3 chance of winning, like we discussed above, you will now have an almost 3 out of 3 chance of winning. And it will actually be possible to push those odds even higher, but more on that next. But as you can see, we will have the ability to put the odds greatly in your favor and now put yourself in the same category as the Vegas casinos. In essence, you have become the house. Number 5 is the ability to adjust. In this world of trading or investing, when the trade goes against us, there is little to nothing you can do except close the trade and take a loss. In other words, if you buy stock and it goes against you, it hits your stop loss order, you take that loss and you're out, or you can hold on and cross your fingers, and usually that ends up being even worse. So now we know that there are many people out there that just try and hold on to those positions, hoping that the underlying will turn around and come back to where they can get out at least at break even. Like I said, that usually doesn't happen. But in so many cases, this strategy only ends up resulting in even bigger losses. But when you're a seller of options, you have many different ways to adjust your options position that will take a position that is in trouble and readjust it where it's once again a healthy trade. And all of these adjustment techniques are taught in our classes, and it's something that can only be done if you're a seller of options. So in essence, you can be employing these adjustment techniques. You can raise your odds from what we already stated, which is almost 3 out of 3, to almost a full 3 out of 3 if you incorporate the adjustments. Number 6, you get paid to buy stock at a discount. So one highly profitable option trading strategy is, instead of just buying the stock outright, you should sell a put option against that same stock that you want to own anyway instead of buying it. This does 2 things for you. First, you will collect the premium for selling that put option. And second, you will sell that put option at a strike price lower than where the stock is currently trading. So what this does is either allows you to collect a premium and never actually buy the stock, or you can do this each week, collecting another premium each time, which is your weekly cash flow that we talked about. Or in the event that the stock moves down in price, then you will end up buying the stock at a discount to where you would have bought it in the first place. Remember, you were going to buy it outright. Also, don't forget all the premium you've collected up to this point, so that this discount is even larger than just the result of getting it at a lower price. So if you have a stock that you want to own, you can either just go out and buy it at full retail, or if you want to play it this way, you can profit each week and maybe even actually end up purchasing it at a discount. Or another way to look at it, buy it wholesale. Number 7, which is tied into this last one, number 6, is get paid to sell the stock at a profit. So in number 6, we talked about getting paid to buy stock that you wanted to buy anyway. So now it's time to talk about, if you ended up buying it at wholesale at a discount, then what do you do next? Well, you could just hold on to the stock and hope it goes up. Remember, that was your intention originally before I showed you a better way to buy the stock. But as you might be guessing, I have a better way to play the stock and then just holding it and crossing your fingers and hoping it moves up in price. Because many times, as we all know, stocks can, even after you end up buying it, it can stay flat for a while, or it can move down even. So as you did with puts, selling them to allow you to buy the stock at a discount, now you should sell calls allowing someone to buy your shares at a profit. Again, as with the past example, you will now once again be selling these calls each week and again collecting a weekly premium, another cash flow, into your account. You can sell these calls at a strike price higher than where the stock is currently trading and higher than the price you paid for the shares. So just like someone paying you to buy the stock at a discount, now someone is paying you to sell your shares at a profit. And this whole process has been generating a nice weekly cash flow the whole time. See, much better than the old buy and hold. Number 8, now time is your friend. We've already stated that most options expire worthless, and for the buyer of option, this is not great odds. But on the other hand, for the option sellers, it's exactly the opposite. Now we really haven't talked much about the time factor in options. We mentioned that they expire, but not much more. So options have a predefined lifespan. They all will expire at some point in the future. So even though there are many different options, all with different expiration dates, the point is that they are all going to expire at a preset date in the future. So for the option buyer, they're working against the clock right from the start. Remember, we already said that when you buy an option, you need the underlying product to move in a specific direction in order for the buyer to profit. Well, as if that was not hard enough, it also has to make that move in a specific amount of time. So now it gets even harder for the buyer, because as each date ticks by, it's time for the underlying to perform as needed is getting shorter and shorter. And since that we already did our research, we know that most options expire worthless, which means that in most cases, the underlying never moves enough within the time that's allowed. So but for the seller, it's exactly the opposite. For the seller, time is their friend. For each day that ticks by, the option is losing time value. This means that the value of the option is decreasing with each passing day. So remember, it's the seller's goal for the option to lose 100% of its value. So if you're a seller, then time is your friend. Number 9, it can be used on all trading instruments. So another really nice thing is about using options, and in our case, selling options, is that they can be used on all markets. You can sell options on equities, you can sell them on currencies, on commodities, futures. No matter what market you want to trade, you can use options to generate cash flow. And we're going to be covering more on that later, so don't worry. And number 10, they can be used in smaller accounts. One last advantage is that you can use these strategies in relatively small accounts. Now, if your account is really small, then you'll have to be more selective in the market you trade. But you'll be able to trade in accounts as small as $1,000. In fact, I have done it in accounts as small as $500, but I would not recommend that because with an account that small, you almost have no ability to adjust if your account is at the 500 level. So if you need to adjust to correct the trade, then you would have to let the trade go, and you could run the risk of blowing out your account. So I would say the minimum size should be at least $1,000, and I will show you before this class is over how you can do that with that size of an account. So I hope now you can see the many advantages of selling options in your account. It wasn't until I started working in the back office trader on Wall Street that my eyes got open to the many advantages of selling versus buying options. And it's really just like Vegas. And you have two very different sides to this business. You have the retail side of the market, where the odds are greatly stacked against you as a retail client, a gambler. And then you have the institutional side, or the brokerage side, which is the house, where they have the odds stacked heavily in their favor. So since you now have a choice as to which side you want to be on, it's now up to you to decide which way you want to go. So moving on to the next part, so how to filter through media noise. And this is a huge problem for the beginning trader as well as for the more advanced traders. And as I've stated many times before, the media has become a giant retail machine funded and used by the brokerage industry to entice unknowing investors into the market. So if you read my blogs, you should have seen the blog where I outline the 4 market cycles. And in the description, I pointed out how the retail investor always ends up getting into a trend too late and getting out too late, which basically means he ends up buying high and selling low. And we all know that this won't work for long. So the first thing you have to know and believe beyond anything else about the media is that no one, no software program, no thing, no show, no person, nothing knows where the price of any stock or currency or futures contract will be at any point in the future. So when you hear any of these analysts come on and start talking about where the price of any stock is going to be in the future, you must realize that they always have some sort of agenda. It's their job to promote that stock. Also remember that the brokerage industry is one of the largest retail businesses in the world, and for them to continue to profit, they must advertise their products just like any retail business. And one of their main products is, of course, the stocks and other instruments they sell and you buy. So the first step you need to take is to totally stop listening to any of the financial news stations. Now myself, I do listen to them, but I'm able to listen with a filter. When I'm listening, I'm only looking for a specific types of information, such as binary events that could move the market, news that could either move a sector or the entire market, and I can totally filter out all the other noise that fills 90% of the daily chatter. But if you're not able to do that, then actually most are not, I would advise you to turn off all the media you possibly can, or if you're going to watch CNBC, at least turn off the sound and just look at the numbers going, but you don't even need to do that really. And this will be a powerful first step which will greatly help clear a lot of that noise for you. I want to point out that no individual or software program or indicator knows where any stock, index, future, currency price will be tomorrow. For that matter, they don't know where the price will be even 1 hour from now. So there are some good analysts out there that do a very, very extensive research on whatever product they're dealing with. But it doesn't matter how much information they compile, there's still no way that they can predict where the price will be at any point in the future, even though they tell you they do. This is where so many traders get into trouble. They watch the financial news stations, they listen to all the analysts reporting on a stock or a market or a sector and where it's going to be in the near future, and after hearing this enough day after day, they start to form opinions. Those opinions end up turning into beliefs. And once a trader forms a belief, then from that point on, all market information that they take in will be tainted to reflect that belief. So any trade they make will be aimed at enforcing that same belief. So they're not seeing things clearly at that point. And once the trade is made, then if it does go bad, then this trader will not see the warning signs and in most cases not close out the trade and manage their risk. Instead, they will stick with their belief and remain in that trade and ride it down while the losses increase because their belief on that trade is so strong that all common sense or trading rules are ignored. So when you enter a trade, you must accept that anything can happen with this trade and any outcome is possible. So once you accept this hard fact, then you will be much more open to admitting the trade was bad and be able to take the loss and move on to the next trade. Remember, the goal of any trader is to have small losses and let the winners run. So I think it's safe to say that in our process of weeding out the bad and useless information, that any type of information that attempts to predict price direction should always be ignored. And why? Because no one knows where the price of anything is going to go. No one. So next on my list is really tied into that last point, and that is instead of media input, you might find yourself getting tips from other fellow traders. And I can personally state that of all the stock tips I've ever received from well-wishing friends, that 100% of the tips that I acted on were losing trades. I can't think of an example. I can't even think of one example to where it's actually been a good choice. Maybe I'm just unlucky, but that's what it's been. So you must not allow yourself to take any trades based on someone else's recommendation. That's also a shortcut. And if you do that, you're going to probably skip a lot of the work you would do to put into it if you were doing the research yourself. By taking this second step, it should further decrease the amount of noise you're experiencing, thus clearing your vision, allowing you to make intelligent trading decisions instead of being herded like a Black Friday shopper. So now that we've identified what you should not pay attention to, let's move on to what you will be important. You will want to pay attention to any information that can cause movement in either the stock that you're trading or going to trade or move the market as a whole. So if we look at data that can move the price of individual stocks, they are, well, of course, earnings reports. And in those, you're going to have an earnings call, and then you're going to have a forward guidance. Sometimes you could get a good earnings report, but then the forward guidance stinks, and they kind of downgrade what's future performance when the stock moves down. Or you could get a bad earnings call to where maybe they've missed earnings, but you get a great forward guidance, so the stock still moves up, even though it didn't do that so well with earnings. So you have to listen to both of those and make an assumption after that. Number 2, dividends. Dividends come out. People like that. Stocks increase their dividends. It also helps the stock. Then there's company news, product news, management changes, legal problems if they get in trouble, accounting problems. All those things can affect the price of the stock, so you want to be aware of all those. And all these things will have the potential to move the price of the stock, so you'll need to be aware of the dates of any scheduled data so you can possibly trade around those if possible. I've seen many people trading specific stocks, and the earnings come out and the stock could move drastically. And the thing about that is most times these announcements come out after market closes. A lot of them come out before. A lot of them, most of them come out after. And then the stock moves in after hours. And then the next morning, the stock is gapped one direction or the other. And it's too late to do anything, and you're stuck in a bad position. So many times, if you know when earnings are going to come out, it may be a good idea to trade around those earnings reports. The next group of important information releases are known as binary events, and some of those are any government or corporate issued statistic that indicates current economic growth and stability. So be aware of when they are released. And some of those are like Fed meetings. Fed meetings can cause big movements in stock. Employment numbers, non-farm payroll, GDP numbers, gross domestic product, any numbers dealing with inflation, retail sales, especially those are important during the Christmas holiday season. Foreign government crises, like when certain countries send missiles to another certain country. I don't know if you watched that last week, but I think once that was announced on the news, overnight futures dropped, Dow futures dropped over 400 points. So that can really affect the market. Any corporate earnings trends, and of course, what we have coming up, federal election, that could have the potential to move the market seriously. And these are relatively easy to find. Some good places to look would be CNBC shows them, Bloomberg shows them, Yahoo Finance does it, Wall Street Journal has them. But if you look, there are many places that post calendars that list the entire month's binary events. And you just want to keep these data releases in mind, as they have the power to move the market as a whole, sometimes quite a bit. So now the next part is to sift through the noise and focus on a very small segment of stocks to track and eventually trade. And again, remember, this is for the beginning trader. It's figuring out how to get into the market and how to start trading. So we're trying to cover what to ignore, what to research, what to acknowledge. And now let's start narrowing down our field of vision. First off, currently there are about 40,000 public companies traded in the U.S. And it would be impossible for anyone to sift through that many stock charts and pick out the best of the best. So don't even try. Now, to make a really nice living trading, you only need a small handful of stocks. What I do for myself is I focus on companies that I can relate to and understand what they do. For instance, I have an engineering background, so I've always focused on tech stocks. They've always served me well. Now, for you, it could be something different. Whatever you have a strong background in or some level of extra knowledge, that might be a good place for you to focus. The whole point of this step is to massively decrease the amount of stocks you look at. So for instance, of the 40,000 or so stocks out there, I tend to look at about 10. That's it, only about 10. And I don't even trade that. I only trade about 4 or 5. Now, I'm sure that there are thousands of other good stocks out there, but I don't need more than the ones I follow. So I put on blinders to all the rest. Now, if for some reason something happens that causes the downfall of all the tech stocks, then I would be forced to go out and find some other sector to trade. But unless that happens, I'm perfectly happy where I'm at. So that's the third step, and to narrow your focus down to a much smaller area of companies that you feel comfortable with and focus on them. Now, I know that people will tell you that you need to be diversified, and I can't argue with that. But at the same time, there is a thing called sector rotation. And that is where you see a mass market movement from one sector to another. And again, in my history, I've tried to diversify into other areas other than tech, and every time I've been disappointed. So I keep coming back to what has always worked for me. And like I said, for you, it can be something totally different. Just find your information area, your comfort area, and work there. Now, whatever group, I'm losing my voice. Now, whatever group or sector you decide to work in, You will always have high flyers, the blue chip companies that tend to perform above the rest. So that's where you will want to start looking. Again, you want to keep narrowing your selection down to a small amount of stocks that you can monitor and not feel overwhelmed. Another good exercise to do is once you start getting a workable group of stocks that you're watching, watch how they tend to perform during market declines or down days. You want to identify the ones that perform better than the rest when the rest of the market is tanking. Another good exercise is to take the same list and look at each of their charts. Now, what you'll be looking for here will be different based on the trading style you're using. For instance, if you're looking to trade profit based on the stocks moving up, then you'll want to find stocks that show better than average strength. On the other hand, if you're trading non-directionally, then you'll be looking for charts that are trending sideways, which is, if you're trading non-directionally, a sideways moving market is your best friend. Either way, regardless of what your trading style is, you want to use these exercises to further narrow down your list. See, we're constantly weeding out and trying to get the list as small as possible. Once you feel comfortable with your group or selection, another factor you will need to address is money management or your risk management. And one of the biggest reasons you only need a handful of stocks is that in many cases, the average trader has a limited amount of funds to trade. So they can't really support more than a few stocks. But too many traders try and push the limits on the positions they carry. And when the markets head south, then their level of fear increases. And they start making decisions based on their fear, as we know, that only leads to more pain. So a lot of the stuff we're doing here is trying to counteract and not put fuel on the fire of your emotions. One of the rules to always remember is not to be fully invested. Always keep a percentage of your total funds in cash. You'll be able to sleep better if the market hits a record or a rough spot, and your emotions will not react as strongly. I like to keep that number somewhere around 50% for myself. Now, I think that if you follow these steps and systematically work your way through, you'll be more than able to decrease the noise to a very manageable level. And again, remember, you only have a limited amount of funds, and that amount can only support a specific number of trades. So that number will also be affected by the prices of the stocks you're looking to trade. So if you're looking at more expensive stocks, then the number of different stocks you will need has to be smaller, or the quantity of shares per trade will need to be less. If, on the other hand, the per share price is lower, then you'll be able to trade either more different stocks or just more shares of fewer stocks. Again, keep in mind, good money management and good risk management. Very important.